Futures and options are inherently risky and not suitable for all investors. Only risk capital should be used. An investor may lose more than the original investment. Past performance is not necessarily indicative of future results.
All right, Matt, here we are. It's March 29th, Thursday.
Yep.
And basically what's happened in the bond market is all three sectors, the 5-year, 10-year, and bonds, they've all put in a nice price, all right, downside support. Those prices are in the bonds 138.20, 10-year 129.20 half, 5-year 122.15. And I'm giving you this off my newsletter, which was on my website yesterday. All right. Now, those are important downside levels, and the fact we've moved above them, you got to think about more upside, all right, in these markets. Now, the bonds have a key price up top at 139.24, and it's real possible that the bears will come in up there and they'll try and sell that. But the most important price up top in the bonds is 140.25. That's the price that even the biggest bear is going to give up if trade gets above that 140.25. All right, so you guys are trading futures, and that's what I do. I'm a futures trader. I scalp futures, but you know, think more about looking for some upside here, okay, and keep those prices in mind. Now, Matt is my option guy. All right. So now we're going to see what Matt's got in mind for us.
All right. Well, obviously this will depend on your market opinion. You know, we saw the bonds clearly break out of that trading range we were in since November. Actually, we broke down below 140, went down and tested that 135.04ish, that big number down there, and.
I mean 135.04, 135.05.
135, was it 05?
Yeah, well, you said 134.
Oh, I'm sorry, no, 135.04-ish is what I meant to say, yeah.
Yep.
And we're seeing the market rebound since then. So the question is the market, this is how I see it, is the market going to get back into that prior trading range, or are there going to be plenty of willing sellers out there? Okay, so you and I have talked about some important numbers around 140.24-ish. Okay.
140.25.
Okay, well, we're it took apart, so close enough for this. So the question is, are we going to get back into that range? Now, if you believe that the bonds are going to fail up there, okay, and we're going to start heading lower again as we see yields working higher, there's two different ways you can play it using short option strategies. Now, short options are not suitable for everybody, okay? If you sell a naked option, okay, you can lose more than your initial investment. Your risk is unlimited, so you have to have active risk management. So that being said, if we see a push to that high 140 number and the market appears to start to stall, one potential trade you could look at is to sell the June 145 call in the bonds for 30 ticks or better. 30 ticks, you're going to collect about $469, okay? Now you want to factor in commissions and fees on, taken out of that, but that's what you're going to look to collect. Now, keep in mind your exposure is unlimited, okay, above 145. So, for those that are not comfortable with an unlimited risk type of position, you could look to sell a call spread. And in this case, I would still look to sell the June 145 call, but I would then look to purchase the June 148 call. Okay, so now you've created a call spread. Now, that position, I think you ought to look to collect at least 20 ticks, so you're talking $312 and change, not including commissions and fees, okay? So you'll have to subtract that. You do want to remember, for a spread, okay, it's 2 contracts, so you're going to have 2 sets of commissions and fees, and as always, you want to factor that into your potential profitability, okay? But those are 2 ways to play it. Now, if the bonds roll back over, these trades will potentially be profitable. Even if the bonds stall there and go sideways, these trades may still potentially be profitable because of the time decay aspect of those options. So those are 2 different ways you can play a run up there if you believe we're going to stall out and go sideways to lower again.
in the, maybe I missed it, but if I do the spread, what's my risk?
Good question, yes. The risk on that spread, we're talking a 3-point spread, okay? So in the bonds, you're talking a risk of $3,000 minus the net premium collected after commissions and fees.
Got it. All right, thanks, man.
No problem.